people love dividend stocks. I understand why. You buy the stock. Every quarter, the company sends you a check. It feels safe. It feels like passive income. It feels like you are getting paid to own quality businesses. And for many dividend stocks, this is true. Coca-Cola has paid dividends for over 100 years. Johnson & Johnson has increased its dividend for 62 consecutive years. These are wonderful businesses that reward shareholders with growing income streams. But not all dividend stocks are created equal. Some dividend stocks are traps. The dividend looks attractive. The yield is high. The company has a long history of payments. But underneath the surface, the business is deteriorating. The dividend is unsustainable. And investors who chase the yield end up losing far more in capital losses than they ever earned in dividend income. I have studied dividend stocks for over 7 decades. I have owned many of the best: Coca-Cola, American Express, Bank of America, Apple. All pay dividends, and they rewarded Berkshire Hathaway shareholders handsomely. But I have also seen countless dividend stocks blow up. Companies that cut or eliminated dividends after decades of payments. Investors who thought they owned safe income stocks woke up to find their dividends gone and their stock prices down 50, 60, 70%. The losses were devastating. And they were avoidable if investors had looked beyond the dividend yield to the underlying business fundamentals.
Today, I am going to warn you about 4 dividend stocks that many investors consider safe, but that I am avoiding completely. These are well-known companies, household names. They have paid dividends for decades. Their yields are attractive, ranging from 4 to 7%. Financial advisors recommend them. Income investors own them in large quantities. Retirees depend on them for living expenses. But all 4 of these companies have serious problems. Their businesses are in decline. Their competitive positions are eroding. Their debt levels are too high. Their dividends are at risk. And I believe that over the next few years, investors in these stocks are going to suffer significant losses. The 4 stocks I am avoiding are AT&T, Walgreens, 3M, and Intel. Let me explain exactly why each of these companies concerns me and why I think their dividends are in danger. But first, let me give you a framework for how to evaluate dividend safety, because understanding this framework will help you avoid not just these 4 stocks, but any dividend trap you might encounter in the future. The first thing I look at is the payout ratio. This is the percentage of earnings that a company pays out as dividends. If a company earns $4 per share and pays $2 in dividends, the payout ratio is 50%. This is healthy. The company is retaining half of its earnings to reinvest in the business or pay down debt or buy back stock. It has a cushion. If earnings decline by 20%, the company can still afford the dividend. But if a company earns $4 per share and pays $3.50 in dividends, the payout ratio is 87%. This is dangerous. There is no cushion. If earnings decline even slightly, the dividend becomes unaffordable. The company has to choose between cutting the dividend or going into debt to maintain it. Neither is good. Many dividend traps have payout ratios above 80 or even above 100%. A payout ratio above 100% means the company is paying more in dividends than it earns. This is clearly unsustainable. The company is borrowing money or selling assets to pay the dividend. This can continue for a while. But eventually, lenders stop lending or assets run out, the dividend gets cut, and the stock price collapses. The second thing I look at is free cash flow. Earnings can be manipulated through accounting, but cash flow is harder to fake. Free cash flow is the cash a company generates after paying all expenses and making necessary capital expenditures. If a company generates $1 billion in free cash flow and pays out $600 million in dividends, that is sustainable. But if a company generates $600 million in free cash flow and pays out $800 million in dividends, that is not sustainable. The company is paying out more cash than it generates. It is burning through reserves or going into debt. This cannot continue indefinitely. I have seen many companies maintain dividends for years while free cash flow was negative. They borrowed money to pay the dividend. Management did not want to cut the dividend because it would signal weakness and cause the stock to crash, so they kept paying and kept borrowing. Eventually,
The debt load became unsustainable. The credit rating got downgraded. Borrowing costs rose. Lenders demanded the dividend be cut as a condition of new financing. And when the dividend was finally cut, the stock fell 40 or 50% in a day. The third thing I look at is the business trend. Is the company growing or shrinking? Is it gaining market share or losing it? Are its products becoming more valuable or less valuable to customers? Are its profit margins expanding or contracting? A company can maintain a dividend while the business is declining for a while, but if the decline continues, eventually earnings and cash flow fall to a level where the dividend is no longer affordable. And by the time the dividend is cut, the stock price has already fallen dramatically because investors can see the deterioration. The best dividend stocks are companies with growing businesses, expanding profit margins, increasing cash flow, and low payout ratios. These companies can not only maintain their dividends, but increase them every year. This is what dividend growth investors look for. Companies like Visa, MasterCard, Microsoft, Johnson & Johnson, these businesses are getting stronger every year. Their dividends are safe and growing. Owning these stocks provides rising income and capital appreciation. The worst dividend stocks are companies with declining businesses, shrinking profit margins, falling cash flow, and high payout ratios. These companies are paying unsustainable dividends to attract income investors. The high yield is a warning sign, not an opportunity. Eventually, the dividend gets cut, and investors lose both the income and a large portion of their capital. Now, let me talk about the first stock I am avoiding, AT&T. This company has been a widow and orphan stock for generations. Retirees owned it for the dividend. The yield was attractive, and the dividend seemed safe because AT&T is a massive company with millions of customers. But I have watched AT&T destroy shareholder value for over 2 decades. The stock price today is lower than it was in 1999, 25 years of going nowhere, and the dividend has been cut. Shareholders who held AT&T for income have suffered badly. AT&T's problems are structural. The company operates in highly competitive, capital-intensive, slow-growth businesses, wireless, broadband, and legacy wireline services. The wireless market is mature. Market share is split between 3 major players, AT&T, Verizon, and T-Mobile. They compete primarily on price. This drives down profit margins. To maintain customers, AT&T has to keep investing billions in network upgrades. 5G rollout costs tens of billions. The return on this investment is low because competitors are making the same investments. The entire industry is running to stand still. The broadband business is even worse. Cable companies and fiber providers are competing for the same customers. AT&T has to invest heavily in fiber to compete with cable. But the cable companies have a head start and a better product in many markets. AT&T is playing catch-up and spending billions to do it. The returns are inadequate. Meanwhile, the legacy wireline business, traditional landline phone service, is in terminal decline. Customers are cutting landlines every year. This business generates less revenue and less profit every year. It is a slow death. AT&T made the situation worse by acquiring DirecTV and Time Warner. These were terrible acquisitions. DirecTV is a satellite television business in an industry that is dying. Customers are cutting the cord and moving to streaming. DirecTV has lost millions of subscribers. The business is worth a fraction of what AT&T paid for it. Time Warner, now called Warner Media, included assets like HBO and Warner Brothers. These are good assets, but AT&T overpaid and had no competitive advantage in running a media company. They eventually spun off Warner Media and merged it with Discovery. Shareholders took a huge loss on that deal. The acquisitions loaded AT&T with debt. At one point, the company had over $170 billion in debt. This is an enormous burden. The interest expense alone was over $8 billion per year. Servicing this debt consumed a huge portion of cash flow, and it limited AT&T's flexibility. They could not invest as aggressively in their networks. They could not return as much cash to shareholders. They were trapped. In 2022, AT&T finally admitted defeat and cut the dividend by nearly 50%. The stock crashed. Shareholders who owned AT&T for income saw their income cut in half overnight, and the stock price fell from $30 to $14, a 50% loss. This is the danger of dividend traps. You own the stock for income, the dividend gets cut, and you lose both income and capital. AT&T is still struggling. The business is not growing. Competition is intense. Debt is still too high. The dividend yield is now around 6%, which looks attractive. But I see this as a warning sign, not an opportunity. The market is pricing in risk. The risk that the business continues to deteriorate. The risk that the dividend gets cut again. The risk that the stock goes nowhere for another decade. I am avoiding AT&T completely. The second stock I am avoiding is Walgreens.
This is another former blue chip that has fallen on hard times. Walgreens is one of the largest pharmacy chains in America, with over 8,000 locations. For decades, it was a stable, profitable business.
People needed prescriptions filled. They went to Walgreens or CVS. The pharmacy generated steady traffic and profits. The front-of-store retail complemented the pharmacy. Walgreens paid a reliable dividend. It seemed like a safe income stock. But the pharmacy business model is broken. Pharmacy benefit managers, PBMs, have enormous power. They negotiate prices with pharmacies on behalf of insurance companies and employers. The three largest PBMs, CVS Caremark, Express Scripts, and Optum Rx, control about 80% of the market. They squeeze pharmacies on reimbursement rates. Walgreens fills a prescription. The PBM reimburses Walgreens at a rate that leaves almost no profit. Sometimes Walgreens loses money on the transaction. The PBMs capture the value. Walgreens is just a low-margin service provider. Front-of-store retail is also struggling. Walgreens competes with Amazon, Walmart, Target, dollar stores, and convenience stores. Customers can buy the same products cheaper online or at big box retailers. Foot traffic in Walgreens stores is declining. The retail business is losing money. Walgreens has tried various strategies to turn this around. They remodeled stores. They added more health services. They partnered with Village MD to put primary care clinics in stores. None of it is working. The clinics are losing money. The remodels did not drive traffic. The business is deteriorating. Walgreens is closing hundreds of stores. They announced plans to close over 1,000 locations. This is an admission that they overexpanded and many stores are unprofitable. But closing stores has costs, lease termination fees, severance, write-downs of assets. This hits earnings and cash flow. And it does not solve the fundamental problem, which is that the business model is challenged. The financial results are terrible. Earnings have collapsed. In fiscal 2023, Walgreens lost money. Free cash flow is barely positive. The dividend payout ratio is over 100% of earnings. This is unsustainable. Walgreens is paying a dividend it cannot afford. Debt has increased to over $30 billion. Credit rating agencies have downgraded Walgreens' debt to near junk status. This raises borrowing costs and makes the financial situation worse. I believe Walgreens will be forced to cut its dividend within the next 2 years. The math does not work. They cannot continue paying out more than they earn while losing money and carrying high debt. When the dividend is cut, the stock will fall dramatically. It is already down from a peak of $64 in 2015 to around $10 today. That is an 84% loss, and I think there is more downside. The yield is currently around 8%, which looks very attractive to income investors. But this is a value trap. The high yield exists because the market knows the dividend is at risk. When it gets cut, shareholders will lose the income and suffer further capital losses. I am staying far away from Walgreens. The third stock I am avoiding is 3M. This company has a storied history. It invented Scotch tape, Post-it notes, and thousands of other products used in manufacturing, healthcare, consumer goods, and electronics. For decades, 3M was a compounding machine. It grew revenue and earnings steadily. It paid increasing dividends for over 60 years. It was a dividend aristocrat, one of the most reliable dividend growth stocks in the market. But 3M is facing enormous problems that threaten the business and the dividend. The first problem is litigation. 3M manufactured PFAS chemicals, also known as forever chemicals, for decades. These chemicals were used in firefighting, foam, water-resistant coatings, and many other applications. They are called forever chemicals because they do not break down in the environment. They persist indefinitely, and they are toxic. Studies have linked PFAS exposure to cancer, liver damage, thyroid problems, and other health issues. 3M faces billions of dollars in potential liabilities. Lawsuits from water utilities claiming 3M contaminated water supplies. Lawsuits from individuals claiming PFAS exposure caused cancer. Lawsuits from military personnel who were exposed to firefighting foam. The total liability is unknown, but estimates range from $10 billion to over $30 billion. 3M has already settled some cases for over $10 billion. More settlements and verdicts are coming. 3M also faces litigation over defective military earplugs. The company sold earplugs to the military that allegedly did not provide adequate hearing protection. Hundreds of thousands of veterans have filed claims alleging hearing loss and tinnitus from the defective earplugs. 3M has lost several trials and faces potentially massive damages. The company set aside over $1 billion for this litigation, but the ultimate cost could be far higher. These legal liabilities are a massive overhang. 3M is paying billions in settlements and legal fees. This consumes cash flow that could otherwise go to dividends, debt reduction, or growth investments. And the liabilities keep growing as new cases are filed and new chemicals are found to be harmful. The second problem is the business itself. 3M's core markets are mature and competitive. Industrial products, automotive, electronics, healthcare all face intense competition and pricing pressure. 3M's profit margins have been declining for years. Operating margins are down from over 20% a decade ago to mid-teens now. Return on invested capital has fallen. The business is not generating the returns it once did. 3M is trying to restructure. They spun off their healthcare business into a separate company called Solventum. The idea was to unlock value and allow each business to focus on its strengths. But the spin-off has not helped the stock price. Both 3M and Solventum have struggled. Investors are not seeing value creation. They are seeing a troubled conglomerate being broken apart because it cannot compete effectively as one entity. 3M's dividend payout ratio is over 90% of earnings. Free cash flow is weak because the company has to invest in legal settlements, restructuring costs, and capital expenditures to maintain competitiveness. Debt has increased to over $15 billion. This is manageable for a company of 3M size, but it limits flexibility. If earnings continue declining and legal liabilities mount, 3M may have to choose between paying the dividend and maintaining financial stability. I expect they will choose financial stability and cut the dividend. The stock has fallen from over $200 in 2018 to around $125 today. The dividend yield is around 6%. Again, this high yield is a warning sign. The market knows the dividend is at risk. When it gets cut, longtime shareholders who own 3M for reliable dividend growth will be devastated. I am avoiding this stock. The fourth stock I am avoiding is Intel. This is a company I have watched for decades. Intel dominated the semiconductor industry for 30 years. They made the processors that powered personal computers and servers. They had a near monopoly. Profit margins were enormous. Cash flow was strong. The dividend seemed safe. But Intel has fallen behind. They lost their technology lead. Competitors are eating their lunch, and the business is struggling. Intel's problems started with manufacturing. For decades, Intel had the most advanced semiconductor manufacturing in the world. They could make smaller, faster, more efficient chips than anyone else. This gave them a huge competitive advantage. But in the mid-2010s, Intel's manufacturing fell behind. They struggled to move from 14 nanometer chips to 10 nanometer to 7 nanometer. Competitors like TSMC and Samsung leapfrogged Intel. They can now make more advanced chips than Intel, and they make chips for Intel's competitors like AMD and NVIDIA. This is a disaster for Intel. AMD now makes better processors for both PCs and servers. AMD has gained significant market share from Intel in the server market, which is highly profitable. AMD has gone from almost zero share to over 25%. Intel is losing its most profitable business. NVIDIA dominates graphics processors and AI chips. Their GPUs are essential for training AI models. Demand is enormous. NVIDIA is making tens of billions in profits. Intel missed this opportunity completely. They tried to compete in GPUs, but their products are not competitive. They are years behind NVIDIA. Intel is trying to catch up by investing over $100 billion in new manufacturing capacity. They are building fabs in Arizona, Ohio, and other locations. The hope is that these advanced fabs will allow Intel to regain its manufacturing lead and compete with TSMC, but this is a massive gamble. The fabs take years to build and ramp up production. Technology changes quickly. By the time Intel's fabs are operational, TSMC may have moved to even more advanced processes. And even if Intel catches up in manufacturing, they still have to design competitive chips. AMD and NVIDIA have better chip architectures right now. Manufacturing alone will not solve Intel's problems. The $100 billion investment in fabs is consuming all of Intel's cash flow and then some. The company is burning cash. Free cash flow is negative. They are borrowing money to fund the CapEx. Debt has increased from $10 billion to over $50 billion, and the dividend consumes another $6 billion per year. This is not sustainable. Intel is paying a dividend it cannot afford while investing massive amounts in a turnaround that may not work. Intel's earnings have collapsed. They went from earning $20 billion per year to losing money in some recent quarters. When they do earn money, the profits are a fraction of what they were. The dividend payout ratio is over 100% of earnings and well over 100% of free cash flow. Intel is borrowing to pay the dividend. This cannot continue for more than a few years. Eventually, debt will reach a level where lenders demand the dividend be cut, or management will cut the dividend to preserve cash for the fab investments. The stock has fallen from $60 in 2020 to $20 today. The dividend yield is around 2%, which is not particularly high. But given the financial situation, even this dividend looks risky. Intel shareholders have already suffered a 66% loss. I think there is more downside. When the dividend is cut and the market realizes Intel may not catch up to competitors, the stock could fall to $10 or $15. I am avoiding Intel completely. Now let me contrast these four troubled dividend stocks with what real dividend safety looks like. Johnson & Johnson is a great example. The company makes pharmaceuticals, medical devices, and consumer health products. The businesses are diversified. The products are essential. Profit margins are strong. Return on capital is high. Debt is manageable. Free cash flow is robust. The dividend payout ratio is around 50%. And the dividend has increased for 62 consecutive years. Johnson & Johnson generates about $18 billion in free cash flow annually. They pay about $12 billion in dividends. This leaves $6 billion for debt reduction, acquisitions, and share buybacks. The dividend is completely sustainable. Even if earnings decline by 20 or 30%, they can still afford the dividend. This is what dividend safety looks like. A strong business, high returns on capital, moderate payout ratio, growing free cash flow. Johnson & Johnson is the type of dividend stock I own and recommend. Coca-Cola is another example. The company has paid dividends for over 100 years. The dividend has increased for 62 consecutive years. Berkshire has owned Coca-Cola since 1988. We paid $1.3 billion for our position. Today it is worth about $25 billion. And we receive over $700 million per year in dividends. Our yield on cost is over 50%. This is the power of owning quality dividend growth stocks and holding them for decades. Coca-Cola's dividend is safe because the business is durable. 2 billion servings of Coca-Cola products are consumed every day. The brand is the most valuable in the world. The distribution system is nearly impossible to replicate. Profit margins are high. Free cash flow is strong. The payout ratio is about 75%, which is higher than ideal, but manageable because cash flow is so strong and stable. Even during the pandemic, when restaurants and theaters were closed, Coca-Cola generated billions in free cash flow. The business is recession resistant. The dividend is safe. Visa and MasterCard are modern examples of exceptional dividend stocks. These companies operate payment networks.
Every time someone swipes a Visa or MasterCard, the companies take a small fee.
The business model is beautiful. No credit risk, no inventory, no manufacturing, just collecting a toll on transactions. And transaction volumes grow every year as the world moves from cash to digital payments. Visa and MasterCard have profit margins over 60%. Return on equity is over 40%. Free cash flow growth is in the double digits annually. They pay modest dividends, yielding less than 1% because they are reinvesting heavily in growth and buying back stock. But the dividends they do pay are completely safe and growing rapidly. Over the past decade, Visa has increased its dividend by over 20% per year. The dividend has grown from 20 cents per share to over $2. This is dividend growth investing at its finest. Now compare these quality dividend stocks to AT&T, Walgreens, 3M, and Intel. The contrast is stark. Johnson & Johnson, Coca-Cola, Visa, and MasterCard have growing businesses, expanding profit margins, high returns on capital, strong free cash flow, and moderate payout ratios. AT&T, Walgreens, 3M, and Intel have declining businesses, shrinking profit margins, lower negative returns on capital, weak or negative free cash flow, and unsustainably high payout ratios. One group is compounding wealth. The other group is destroying it.
The lesson is clear: do not chase yield. A high dividend yield is often a warning sign, not an opportunity.
It means the market expects problems. Either the dividend will be cut or the business will continue deteriorating, or both. Investors who buy high-yield dividend stocks hoping for safe income often end up with dividend cuts and capital losses. This is the opposite of what they wanted. Instead, focus on dividend safety and dividend growth. Buy companies with strong businesses, sustainable competitive advantages, high returns on capital, and moderate payout ratios. These companies may not have the highest yields today, but their dividends are safe. And more importantly, their dividends will grow over time. A 3% yield that grows at 10% per year becomes a 6% yield on your original cost in 7 years. And the stock price will likely appreciate as the business grows. You get both income growth and capital appreciation. This is how I think about dividend investing. Quality first, safety first, growth second, yield is a distant third. If I find a quality business with a safe and growing dividend, I do not care if the current yield is only 2 or 3%. I care that the business will be worth more in 10 years and the dividend will have doubled or tripled. That is what builds wealth over time. Let me share some additional thoughts on how to identify dividend traps before you get caught. The first red flag is a dividend yield significantly higher than the market average or the company's historical average. The S&P 500 yields about 1.5%. If you find a stock yielding 6 or 7 or 8%, ask yourself why. What does the market know that you do not? Usually, the high yield exists because the stock price has fallen due to business problems, and the market is pricing in a high probability of a dividend cut. Do not be fooled by the high yield. It is a trap. The second red flag is a declining stock price over multiple years despite a maintained dividend. If a company has paid the same dividend for 5 years, but the stock price is down 30 or 40%, something is wrong. The business is deteriorating. Investors are losing confidence. Management is maintaining the dividend to avoid admitting problems. But eventually, the dividend will be cut. Get out before that happens. The third red flag is a payout ratio above 80% or free cash flow payout above 100%. These are mathematical warning signs that the dividend is unsustainable. The company does not generate enough earnings or cash to support the dividend long term. Something has to give. Either earnings and cash flow must increase significantly or the dividend must be cut. Betting on a big increase in earnings when the business is already struggling is not wise. The safer assumption is that the dividend will be cut. The fourth red flag is increasing debt while paying dividends. If a company is borrowing money to fund operations or acquisitions while also paying dividends, this is a sign of financial stress. In a healthy company, cash flow covers both investments and dividends, with cash left over to reduce debt. If debt is increasing, cash flow is insufficient. The dividend is being paid from borrowed money. This is not sustainable. The fifth red flag is management statements defending the dividend when questioned. If analysts ask about dividend sustainability and management gets defensive or provides vague reassurances, that is a warning. Confident management with a safe dividend will show you the numbers. They will walk through cash flow, payout ratios, debt levels, and explain exactly why the dividend is sustainable. Defensive or vague management is hiding problems. AT&T exhibited all 5 of these red flags for years before cutting the dividend. The yield was over 7%. The stock price had fallen from $40 to $30 over 5 years despite a maintained dividend. The payout ratio was over 90%, debt increased to over $170 billion, and management kept insisting the dividend was safe right up until they cut it. Investors who paid attention to the red flags could have avoided the disaster. Investors who chased the yield suffered badly. Walgreens is exhibiting the same red flags right now. Yield over 8%, stock price down from $64 to $10 over 9 years. Payout ratio over 100%, debt increasing, management defending the dividend. This is a textbook dividend trap. The dividend will be cut. It is just a question of when. Investors who own Walgreens for income should sell now before the cut happens. 3M and Intel also show multiple red flags. High yields relative to history, declining stock prices, unsustainable payout ratios, increasing debt. These are not safe dividend stocks. They are accidents waiting to happen. Let me address one more important point. Some investors think they can hold dividend stocks through a cut and come out ahead because they collected dividends along the way. This is usually wrong. When a dividend is cut, the stock price typically falls by far more than the dividends you collected. AT&T is a perfect example. From 2015 to 2022, AT&T paid about $15 per share in cumulative dividends, but the stock fell from $40 to $14, a $26 loss. You collected $15 in dividends, but lost $26 in capital. You were down $11 net. This is not a winning strategy. The same pattern plays out with most dividend cuts. General Electric cut its dividend in 2017.
Shareholders who held through the cut collected a few dollars in dividends, but lost $50 per share in capital as the stock fell from 30 to 6. The dividends did not come close to offsetting the capital loss.
You would have been far better off selling when the warning signs appeared and avoiding the disaster. This is why I emphasize selling dividend stocks when red flags appear rather than holding for the dividend. The dividend is not worth the capital loss. If I see a business deteriorating, a payout ratio rising, debt increasing, I sell. I do not wait for the dividend cut. By the time the cut happens, most of the damage to the stock price is already done. The smart investors sold months or years earlier when the warning signs first appeared. Now let me talk about what I am buying instead of these 4 troubled dividend stocks. I am buying quality businesses with durable competitive advantages, strong balance sheets, and the ability to grow earnings and dividends over time. I already mentioned Johnson & Johnson, Coca-Cola, Visa, and MasterCard. These are the types of businesses I want to own. But let me give you a few more examples that I think are excellent dividend growth investments. Apple is now one of Berkshire's largest holdings. Apple pays a dividend yielding less than 1%. This does not sound exciting, but Apple generates over $100 billion in free cash flow annually. They pay about $15 billion in dividends. The payout ratio is only 15%. This dividend is extraordinarily safe, and Apple is increasing the dividend by about 10% per year. Over time, the yield on cost will become very attractive. Plus, Apple is buying back enormous amounts of stock. They have reduced share count by over 40% in the past decade. This increases earnings per share and makes each remaining share more valuable. Shareholders benefit from both dividend growth and capital appreciation. Microsoft is similar, low current yield around 1%, but massive free cash flow over $70 billion per year, dividend of about $20 billion, payout ratio under 30%. The dividend is completely safe and growing. Microsoft is one of the best businesses in the world. Cloud computing through Azure, office productivity through Microsoft 365, LinkedIn, gaming through Xbox, all growing, all highly profitable. This company will be worth far more in 10 years. The dividend will have doubled or tripled, and the stock price will be much higher. This is a far better investment than chasing a 7% yield from a declining business like Walgreens. Costco is another favorite. The company operates on razor-thin profit margins. They charge members an annual fee for access to the warehouse. Then they sell goods at the lowest possible markup. This drives enormous loyalty and traffic. Customers love Costco because they get great value. Shareholders love Costco because the business model is brilliant. Competitors cannot replicate it. The membership fee revenue is highly profitable. The business generates strong free cash flow. Costco pays a modest regular dividend plus occasional special dividends. The total payout is reasonable and sustainable. And the business keeps growing. More members, more warehouses, higher sales per warehouse. This is a compounding machine. Berkshire itself is a dividend stock in a sense. We do not pay a cash dividend, but we own dozens of businesses that pay us dividends. We receive billions annually from our equity positions in Apple, Bank of America, Coca-Cola, American Express, and others. This cash flow supports our insurance operations and allows us to invest in new opportunities. Berkshire shareholders benefit from the compounding of these dividends even though they do not receive a direct cash payment. Over time, Berkshire's intrinsic value per share grows as these businesses grow and pay us increasing dividends. The key insight is that dividend investing is not about maximizing current yield. It is about owning quality businesses that will pay you increasing amounts of cash over time while the underlying business value grows. This requires patience. You have to be willing to accept a lower yield today in exchange for safety and growth. But the long-term results are far superior. Let me close with a final warning and some specific recommendations. The 4 dividend stocks I am avoiding, AT&T, Walgreens, 3M, and Intel, are all traps. They look safe because they have long dividend histories and attractive yields. But the businesses are deteriorating. The dividends are unsustainable. Over the next few years, these companies will likely cut their dividends. When that happens, shareholders will suffer both income loss and capital loss. If you own any of these stocks, I urge you to reconsider. The dividend is not worth the risk. Instead, focus on quality dividend growth stocks. Companies with strong businesses, high returns on capital, growing free cash flow, and moderate payout ratios. Johnson & Johnson, Coca-Cola, Visa, MasterCard, Apple, Microsoft, Costco. These are the types of businesses that reward long-term dividend investors. The yields may be lower today, but the dividends are safe and growing, and the total returns over time will be far superior. Dividend investing done right is one of the best strategies for building wealth. Dividend investing done wrong, chasing high yields from deteriorating businesses, is a path to losses and disappointment. Study the businesses. Analyze the fundamentals. Look for red flags. Demand quality and sustainability. If you do this, you will build a portfolio of dividend stocks that provides growing income and capital appreciation for decades. That is what I have done at Berkshire, and that is what I recommend you do as well. Now let me go deeper into historical examples of dividend cuts to show you the pattern, because once you see this pattern repeated across decades and dozens of companies, you will never look at high-yield dividend stocks the same way again. Understanding these case studies will save you from making the same mistakes millions of other investors have made. General Electric is perhaps the most dramatic example from my lifetime. GE was considered one of the safest, most reliable dividend stocks in America for over a century. The company paid uninterrupted dividends from 1899 through 2017, 118 consecutive years. GE was a Dow component. It was a core holding for income investors and retirees. The dividend seemed untouchable, but the business was deteriorating for years before the dividend was finally cut. Under CEO Jeff Immelt, from 2001 to 2017, GE made a series of terrible decisions. They overpaid for acquisitions in financial services, oil and gas, and power generation. They loaded the company with debt to fund these deals. The financial services arm, GE Capital, took huge losses during the 2008 crisis. The power business collapsed as utilities shifted from gas turbines to renewables. The oil and gas business crashed when oil prices fell. Losses mounted. Cash flow deteriorated. But GE kept paying the dividend. By 2016, it was obvious to anyone paying attention that GE's dividend was unsustainable. The payout ratio was over 100% of earnings. Free cash flow was barely positive. Debt was over $100 billion. The businesses were struggling. But management insisted the dividend was safe. They kept paying the same 32-cent quarterly dividend they had paid for years. Investors who trusted management kept holding for the dividend. In November of 2017, GE cut the dividend from 32 cents to 12 cents per quarter, a 62% cut. The stock fell from $24 to $18 in one day. But that was just the beginning. In December of 2018, GE cut the dividend again to 1 cent per quarter, a 92% cut from the original level. The stock fell to $7. Shareholders who bought GE at $30 for a 3% yield and held through the cuts lost over 75% of their capital. The dividends they collected along the way were meaningless compared to the capital destruction. GE's total return from 2000 to 2020 was negative 60%. You lost 60% of your money, including dividends, over 20 years. Meanwhile, the S&P 500 was up over 200%, including dividends. GE shareholders did not just underperform. They lost money while the market tripled. This is the devastation that dividend traps can inflict. Another painful example is Kraft Heinz. This company was created in 2015 when Kraft merged with Heinz in a deal backed by Berkshire and 3G Capital. I was involved in this deal and I made a mistake. We paid too much. We assumed we could cut costs aggressively and improve profitability. We were wrong. The business was weaker than we thought. Consumer preferences were shifting away from processed foods. Competition was intense. Price increases were difficult. The cost cuts hurt product quality and brand perception. Kraft Heinz's earnings disappointed year after year. The stock fell from over $90 to below $30. In 2019, the company cut its dividend by 36%. This was an admission that the dividend was unsustainable and cash flow was insufficient. The stock fell further. Berkshire took a $3 billion write-down on our investment. We lost money. Other shareholders lost far more if they bought at the peak. The lesson from Kraft Heinz is that even good investors make mistakes. We thought we were buying quality food brands at a reasonable price. We thought cost cuts would improve profitability. We were wrong. The brands were weaker than we thought. The industry dynamics were unfavorable. When we realized our mistake, we should have sold or at least stopped adding to the position. Instead, we held and hoped things would improve. They did not. The dividend got cut. Shareholders suffered. These examples, GE and Kraft Heinz, show that no company is immune. Even century-old dividend aristocrats can cut dividends when the business deteriorates. Even investments backed by Berkshire and Warren Buffett can go wrong. The key is to watch for warning signs and act before the cut happens. Do not assume the dividend is safe just because it has been paid for decades. Analyze the current business and financial situation. If the metrics are deteriorating, sell. Now let me provide much more detailed financial analysis on the 4 stocks I am avoiding. For AT&T, the numbers are ugly. Revenue has been flat to declining for years. In 2019, revenue was $181 billion. In 2023, revenue was $122 billion. This is a 32% decline. Part of this is due to divestitures of Warner Media and other assets. But organic revenue is not growing. The business is shrinking. Operating income has collapsed. In 2019, AT&T earned $35 billion in operating income. In 2023, they earned $20 billion. This is a 43% decline. Operating margin has gone from 19% to 16%. The business is less profitable. Free cash flow is weak. In 2023, AT&T generated $16 billion in free cash flow. They paid $9 billion in dividends. This seems sustainable on the surface, but the free cash flow number is after about $20 billion in capital expenditures. and AT&T must keep investing heavily in their network or they will fall further behind competitors. So the $16 billion in free cash flow is not cushion. It is what is left after necessary investments. Debt is still $78 billion net of cash. Interest expense is about $5 billion per year. This is a significant burden, and the debt is unlikely to decline much because free cash flow after dividends is only $7 billion. It would take over 10 years to pay off the debt at this pace. Meanwhile, debt eventually needs to be refinanced at higher rates. This will increase interest expense and reduce free cash flow further. AT&T stock trades at about $21. The dividend is 1.11 per share annually. The yield is about 5.3%. The payout ratio is about 60% of projected earnings for 2024. This seems reasonable, but I am skeptical of the earnings projections. The business is not growing. Competition is intense. I expect earnings to decline over the next few years as competitive pressures intensify and capital expenditures remain elevated. If earnings fall, the payout ratio will rise. AT&T may face another dividend cut in the next 3 to 5 years. I am avoiding this stock. For Walgreens, the deterioration is even more severe. Revenue peaked at $140 billion in fiscal 2022. It has since fallen to $139 billion in 2023 and is projected to decline further. The pharmacy business is low margin and getting worse. Reimbursement rates from PBMs keep getting squeezed. Front-of-store retail is losing money. Walgreens reported operating losses in some recent quarters. This is shocking for a company that was reliably profitable for decades. Free cash flow has collapsed from over $5 billion annually a few years ago to barely positive now. In fiscal 2023, Walgreens generated about $1.5 billion in free cash flow. The dividend consumes about $1.2 billion. So there is minimal cushion, and this assumes capital expenditures are not cut further. Walgreens has been underinvesting in store maintenance and technology to preserve cash. This is a short-term fix that makes long-term problems worse. Underinvestment leads to store deterioration, which drives customers away, which reduces sales. It is a death spiral. Debt has increased to $31 billion from about $20 billion a few years ago. Interest expense is about $1.7 billion per year. Credit rating agencies have downgraded Walgreens to BBB, minus one notch above junk. If they are downgraded to junk, borrowing costs will spike. This would force major changes, either massive cost cuts, asset sales, or dividend elimination. Walgreens trades at about $10 per share. The annual dividend is 48 cents per share. The yield is about 4.8%, but I expect this dividend to be cut to zero within 2 years. The business cannot support it. When the cut happens, the stock could fall to $5 or $6. Investors chasing the 5% yield will lose 50% of their capital. This is a classic value trap. For 3M, the financial picture is complicated by the spin-off of the healthcare business. The remaining 3M has revenue of about $23 billion and operating income of about $4 billion. Operating margins are around 17%, which is decent but declining. Return on invested capital has fallen from over 30% a decade ago to mid-teens now. The business is less profitable and generating lower returns. The crushing burden is litigation. 3M has paid over $10 billion in PFAS settlements already. More cases are pending. The ultimate liability could be another $10 to $20 billion. This is on top of earplug litigation, which has cost over $1 billion and is ongoing. These legal costs are consuming cash flow that would otherwise go to shareholders. Free cash flow for 3M is about $4 billion per year. The dividend consumes about $3 billion. This leaves only $1 billion for debt reduction, acquisitions, or share buybacks. And if legal settlements accelerate, free cash flow could turn negative. 3M would then be borrowing money to pay the dividend. This is unsustainable. The dividend will likely be cut within the next few years. 3M's stock trades at about $125. The annual dividend is $6 per share. The yield is about 4.8%. The payout ratio is about 75% of free cash flow, which is on the edge of sustainability. If free cash flow declines due to legal costs or business deterioration, the dividend will have to be cut. I am avoiding 3M. For Intel, The numbers are the worst of the four. Revenue has been flat to declining. In 2021, Intel earned $79 billion in revenue. In 2023, revenue was $54 billion. This is a 32% decline in 2 years. Part of this is due to weak PC demand, but Intel is also losing market share to AMD in both PCs and servers. The revenue decline is both cyclical and structural. Operating income has collapsed. In 2021, Intel earned $30 billion in operating income. In 2023, they lost $2 billion. This is a $32 billion swing from profit to loss in 2 years. Operating margin went from 38% to negative 4%. The business is not just shrinking, it is losing money. Even in quarters where Intel is profitable, operating margins are in the single digits. This is a disaster for a company that used to have 40% margins. Free cash flow is deeply negative. In 2023, Intel burned over $16 billion in cash. Capital expenditures for new fabs are about $25 billion per year. Operating cash flow is only about $9 billion, so free cash flow is negative $16 billion. Intel is borrowing money to fund the fab construction and to pay the dividend. Total debt has increased from $10 billion in 2019 to over $50 billion today. This is unsustainable. Intel pays $1.25 per share in annual dividends. At a stock price of $20, this is a 6.25% yield. Wait, that does not match what I said earlier about 2%. Let me correct that. Intel's dividend yield varies based on the stock price. At recent prices around $20, the yield is over 6%. This high yield reflects the market's view that the dividend is at risk. And the market is right. Intel is paying $6 billion in dividends annually while burning over $16 billion in cash. This cannot continue. The payout ratio is infinite because earnings are negative. Even in quarters where Intel is profitable, the payout ratio is over 100%. Free cash flow payout ratio is not calculable because free cash flow is negative. By any measure, this dividend is unsustainable. Intel will be forced to cut the dividend to preserve cash for fab investments. When the cut happens, the stock could fall to $15 or even $10. I am avoiding Intel completely. Now let me talk about sector-specific challenges that make these four stocks particularly risky. AT&T operates in telecommunications, which has become a commodity business. Wireless service is undifferentiated. Consumers choose based on price and coverage. The three major carriers match each other on pricing. This keeps margins low, and the capital intensity is enormous. 5G required tens of billions in investment. 6G will require more. The return on this investment is minimal because competitors make the same investments. You cannot gain a sustained advantage. You are just running to stand still. The only way telecom companies can make money is through scale and cost discipline. Verizon has been more disciplined than AT&T. They avoided the media acquisitions that destroyed value for AT&T. Verizon's balance sheet is cleaner. Their dividend is safer, though still not a stock I would buy. T-Mobile is the growth story. They gained share through aggressive pricing after the Sprint merger. But even T-Mobile faces the same long-term challenges. Telecom is not a good business. I avoid the entire sector. Walgreens operates in retail pharmacy, which is structurally challenged. The pharmacy benefit managers have all the power. They dictate reimbursement rates. Pharmacies are price takers. They have no negotiating leverage. The only way to make money is through volume. Fill as many prescriptions as possible at minimal margin and hope the volume generates acceptable profits. But this is a race to the bottom. PBMs keep squeezing margins. Pharmacies cannot resist. The model is broken. Front-of-store retail is even worse. Walgreens competes with Amazon, Walmart, Target, dollar stores, convenience stores, and grocery stores for the same customers buying the same products. Walgreens has no competitive advantage. Customers buy at Walgreens out of convenience when they are picking up a prescription, but they can get better prices and selection elsewhere. E-commerce is taking share. Physical retail traffic is declining. Walgreens is stuck in a dying business model. The only solution is to massively shrink the store base and pivot to healthcare services. But this transformation will take years and require billions in investment. I am not confident management can execute it. I am avoiding the entire retail pharmacy sector. 3M operates in industrial conglomerate space, which has fallen out of favor. Conglomerates were popular in the 1960s and 70s. The idea was that diversification reduced risk and professional management could allocate capital better than the market. This proved wrong. Conglomerates trade at discounts to the sum of their parts. Investors prefer pure plays. They want to choose their own diversification. Conglomerates have too much complexity. Management spreads itself too thin. Capital allocation is poor. Acquisitions usually destroy value. 3M is a textbook example of conglomerate problems. They operate in too many markets: industrial adhesives, automotive parts, healthcare products, consumer goods, electronics. Each market has different dynamics and competitors. 3M cannot be the best in all of them. They are spread too thin. And the corporate overhead is enormous. The conglomerate structure adds cost without adding value. This is why activists have been pushing 3M to break up. The healthcare spinoff was the first step. More divestitures may follow. But breaking up a conglomerate is messy and expensive. Value is often destroyed in the process. I am avoiding conglomerates in general, and 3M specifically. Intel operates in semiconductors, which is a brutal business, extremely high capital intensity, massive technology risk, short product cycles, cyclical demand, winner-take-most dynamics. It is very hard to make sustained high returns in semiconductors unless you have a dominant position. Intel used to have that position. They lost it. Regaining it will be extraordinarily difficult and expensive. The semiconductor industry is also increasingly concentrated. TSMC dominates manufacturing. NVIDIA dominates GPUs and AI accelerators. AMD is strong in CPUs. Qualcomm dominates mobile chips. Broadcom and Marvell are strong in networking chips. Each company has a niche where they are best in class. Intel is no longer best in class in anything. They are a distant second or third in most markets they compete in. Without a dominant position, returns will be mediocre at best. And given the capital requirements, mediocre returns mean value destruction. I am avoiding the entire semiconductor sector except for TSMC and NVIDIA, which have clear competitive advantages. Now let me give you more detailed recommendations on what to buy instead. I mentioned Johnson & Johnson, Coca-Cola, Visa, MasterCard, Apple, Microsoft, and Costco. Let me add a few more with specific financial metrics to show you what dividend safety looks like. Procter & Gamble is a wonderful dividend stock. The company makes consumer staples, Tide detergent, Charmin toilet paper, Pampers diapers, Gillette razors, Crest toothpaste. These are products people buy regardless of the economy. Demand is stable. Pricing power is strong because the brands are trusted. P&G has increased its dividend for 68 consecutive years. The current yield is about 2.4%. P&G generates about $18 billion in free cash flow annually. They pay about $9 billion in dividends. Payout ratio is 50%. This is ideal. The dividend is completely safe, and P&G is buying back stock aggressively. They have reduced share count by about 30% over the past 2 decades. Combined with dividend increases, total shareholder returns have been excellent. The stock has compounded at about 10% annually for decades. This is what quality dividend investing looks like. Procter & Gamble's operating margin is about 24%. Return on invested capital is about 25%. These are excellent metrics. The business generates high returns without requiring massive capital investment. Free cash flow conversion is over 90%. Almost all of earnings turn into cash. Debt is moderate at about $28 billion against annual EBITDA of $23 billion. The balance sheet is strong. There is zero risk to the dividend. Chevron is another stock I like for dividends. The energy sector is out of favor. Many investors avoid oil and gas due to ESG concerns or belief that electric vehicles will destroy demand. I think these concerns are overblown. The world will need oil and gas for decades. Chevron is one of the best positioned companies. They have low-cost production, strong balance sheet, disciplined capital allocation, and a safe, growing dividend. Chevron generates about $15 to $20 billion in free cash flow, depending on oil prices. At $60 oil, free cash flow is about $15 billion. At $80 oil, it is about $25 billion. The dividend's about $11 billion annually. Even at low oil prices, the dividend is covered. Chevron has increased its dividend for 37 consecutive years. The current yield is about 3.6%. Chevron's payout ratio is about 50 to 60% of free cash flow at current oil prices. This is sustainable. And if oil prices rise, the payout ratio falls. Chevron uses excess cash to buy back stock. They repurchased about $10 billion in stock in 2023. This reduces share count and increases earnings per share. Shareholders benefit from both dividend growth and buybacks. Chevron's balance sheet is fortress strong. Net debt is about $10 billion against annual EBITDA of $40 billion. Debt to EBITDA ratio is 0.25. This is minimal. Chevron could pay off all debt with 1 year of cash flow if they wanted. Instead, they maintain modest debt for tax efficiency and use cash for dividends and buybacks. The dividend is completely safe even if oil falls to $40. I would not hesitate to own Chevron for dividend income. AbbVie is a pharmaceutical company spun off from Abbott in 2013. The company makes Humira one of the best-selling drugs in the world, along with a portfolio of other drugs in immunology, oncology, and neuroscience. Humira is facing biosimilar competition now. Revenue from Humira is declining. But AbbVie has developed new drugs like Skyrizi and Rinvoq that are growing rapidly. These new drugs are replacing Humira revenue. The business is transitioning successfully. AbbVie generates about $20 billion in free cash flow annually. The dividend is about $9 billion. Payout ratio is about 45%. This is very safe. AbbVie has increased its dividend every year since the spinoff. The current yield is about 3.6%. The company is also buying back stock aggressively. They repurchased $10 billion in 2023. AbbVie's operating margin is about 38%. This is excellent for a pharmaceutical company. Return on equity is over 40%. The business generates extremely high returns. Debt is elevated at about $60 billion due to the Allergan acquisition in 2020, but AbbVie is paying down debt rapidly with free cash flow. Debt to EBITDA is about 2.5 and declining. The balance sheet is manageable. The dividend is safe. And the business has a pipeline of new drugs that should drive growth for years. Now let me talk about portfolio construction for dividend investors. Many income investors make the mistake of concentrating too heavily in high-yield stocks. They build portfolios yielding 5 or 6% by owning AT&T, Walgreens, 3M, Intel, and similar stocks. This feels good because the income is high, but the risk is enormous. When dividends get cut and stock prices fall, the portfolio gets destroyed. A better approach is to build a diversified portfolio of quality dividend growth stocks with moderate current yields. Target a portfolio yield of 2.5 to 3%. This seems low compared to 5 or 6%, but the difference is the 2.5 to 3% is safe and growing. The 5 to 6% is risky and likely to be cut. Over 10 years, the quality dividend portfolio will generate far more income and capital appreciation than the high-yield portfolio. Here is an example portfolio. 25% in consumer staples like Procter & Gamble, Coca-Cola, Pepsi, Colgate, Church, and Dwight. These companies generate stable cash flows and pay reliable dividends. 25% in healthcare like Johnson & Johnson, AbbVie, Eli Lilly, Merck, United Health. Healthcare demand is growing as the population ages. These businesses have pricing power and strong cash flows. 25% in technology like Apple, Microsoft, Visa, MasterCard, Accenture. Technology is the growth engine of the economy. These companies generate enormous cash flows and can grow dividends rapidly. 25% in financials and industrials like JP Morgan, Berkshire, Costco, Chevron, NextEra, Energy. These provide diversification and exposure to different economic drivers. This portfolio would yield about 2.8% currently, but every company in it is increasing dividends at 5 to 10% annually. In 5 years, the yield on cost will be 4 to 5%. In 10 years, it will be 6 to 8%. And the stock prices will likely have doubled or more because the underlying businesses are growing and total return will be excellent. This is how you build wealth through dividend investing. Compare this to a high-yield portfolio of AT&T, Walgreens, 3M.
Intel and similar stocks, current yield is 6%, but dividends are getting cut. In 5 years, the income is down to 3%. The stock prices are down 40 to 50%.
Total return is deeply negative. You destroyed capital chasing yield. This is the path most income investors take, and it ends badly. Let me address tax considerations because these are important for dividend investors. Qualified dividends are taxed at capital gains rates 15 or 20% for most investors. This is much more favorable than ordinary income tax rates, which go up to 37%. To qualify, you must hold the stock for 61 days during the 121-day period around the ex-dividend date. Most long-term dividend investors easily meet this requirement. Dividends from REITs and MLPs are taxed as ordinary income, not qualified dividends. This makes them less attractive for taxable accounts. If you want REIT or MLP exposure for yield, hold them in IRA or 401k accounts where the tax is deferred. In taxable accounts, focus on stocks that pay qualified dividends. Dividend growth stocks are particularly tax efficient. If you buy a stock yielding 2% and hold for 20 years while the dividend grows to 8% yield on cost, you only pay tax on the dividends as you receive them. The capital gains are not taxed until you sell. This allows compounding to work tax efficiently. Compare this to bonds where the interest is taxed as ordinary income every year. Dividend growth stocks are far more tax efficient over long holding periods. Let me close with thoughts on monitoring dividend health. Once you own a dividend stock, you need to monitor it regularly to make sure the dividend remains safe. I review Berkshire's dividend stocks quarterly when earnings are reported. I look at several key metrics. First, free cash flow. Is it growing, stable, or declining? If free cash flow is growing, the dividend is probably safe. If it is declining, I investigate why. Is it temporary due to economic weakness or cyclical factors? Or is it structural deterioration in the business? Temporary declines are acceptable. Structural declines are a warning to consider selling. Second, payout ratio. Is it stable or rising? If the payout ratio is 70% and stays there for years, that is fine. But if it rises from 70 to 80 to 90%, that is a warning. The business is weakening. Earnings are falling. The dividend is consuming a larger share of profits. Eventually, it becomes unsustainable. Third, debt levels. Is debt increasing or decreasing? If a company is paying down debt while maintaining the dividend, that is healthy. But if debt is increasing, that is concerning. The company may be borrowing to fund operations or to pay the dividend. This is not sustainable long term. Fourth, management commentary. What is management saying about the dividend? Confident management will affirm the dividend and explain why it is sustainable. They will point to free cash flow, payout ratios, and balance sheet strength. Defensive management will avoid the topic or give vague reassurances. If management sounds defensive about the dividend, that is a red flag. Fifth, analyst estimates. What are analysts projecting for earnings and free cash flow? If estimates are rising, the dividend is probably safe. If estimates are falling, especially if they fall below the dividend amount, that is a warning. The dividend may be cut. AT&T, Walgreens, 3M, and Intel all showed deteriorating metrics on every one of these measures for multiple quarters or years before their dividends were cut or became at risk. Investors who monitored these metrics could have sold early and avoided most of the damage. Investors who ignored the warnings and held for the yield suffered badly. The lesson is clear. Dividend investing requires active monitoring. You cannot just buy a stock for yield and forget about it. You must review the fundamentals regularly. When red flags appear, you must act. Sell before the dividend is cut. Do not wait and hope things improve. They usually do not. If you follow this discipline, focus on quality businesses, demand sustainable payout ratios, monitor metrics quarterly, and sell when red flags appear, you will build wealth through dividend investing. You will avoid the traps. You will own businesses that pay you growing income for decades. This is the path I have followed at Berkshire. This is what I recommend to individual investors. Quality, safety, discipline. That is the formula for successful dividend investing.